Two moms, two marketers, two women new to the financial industry. They have a lot of questions. That's why they're bringing in financial experts to educate all of us here on A Penny or Two for Your Thoughts.
Giddy up.
Giddy up. Yep. Hey everyone, it's Chantel and Liz with God bless every time.
This is a podcast called A Penny or Two for Your Thoughts. This episode is the last episode. Chantel and Liz will be hosting.
I don't know. Every time. I think I come in thinking I'm all prepared and I'm not.
Well, we really literally say, okay, are you ready? Okay, yep, let's go. And then it's...
Listen, you know why? Because the internet is breaking right now.
Yeah.
Right now.
That's why I can't get on the internet right now.
Right.
Yep.
Today, as we are recording this, the news of Taylor Swift and Travis Kelce getting engaged has stormed through the world.
It's pretty much broken the internet.
Yeah. So we're sitting at lunch. So Liz was working from home. And so she wasn't at lunch table today.
Nope.
And all of a sudden, all of our phones are like, oh, is this real? Is this fake news? And then like the whole lunchroom like explodes. We're all talking about it. You know, what's happening? Is this real? Is this real? So listener, I usually like to throw my son under the bus on these episodes. And so I'm totally going to do it today. He is a huge Taylor Swift fan. And so I text him and I said, oh my gosh, they're engaged. And there was like no response. And then he goes, who? I'm like, are you kidding me right now? And then he figures it out. He texts me back after you asked me what he said. Uh-huh. I'm sobbing, Mom. God.
As is the rest of the world.
I can't with him. Oh my goodness. Anyway, lots has happened since the last podcast that we had.
When did we have our last one?
It seemed like forever ago, but your little started school.
She did.
And my little entered his senior year. I was thinking about that this morning going, oh my goodness.
We literally have the bookends.
Yes.
We're like only a couple years apart in age. However, our kids are on the bookends.
So yeah.
Listeners, it's not that Chantel started really, really early. I started really late. So,
but it's great. Like she's doing awesome. She loves it.
She is so funny. I'm going to throw her under the bus because she really doesn't listen to this podcast and probably will never listen to this podcast. Or it might just spring up in the archives someday and she'll be like, what the heck, Mom?
Yeah, you're embarrassing.
Okay. So she's on her third week.
Okay.
Like this is her second full week.
Okay.
And last night she was just like, we've noticed it over the past few school nights, but she's just really whiny and like snappy and like bossy, and she's 5 people. She's 5. She's 5 going on 16. And so last night we put her to bed and I just looked at my husband. I'm like, what the heck is going on? And I was like, I think I know what it is. I think we need to get her to bed earlier.
Oh,
I think she is so exhausted because her little brain now is on full-fledged school mode.
Yeah, learning all the things.
And they go from 8 a.m. until 3:30, and she's not used to that level of knowledge coming at her.
Right.
She's just exhausted.
So that's a good plan.
Yeah.
Especially when the time changes too. It works out real because it'll fall back. So it'll get darker so you can really play that.
Really play that. Yeah, right now it's hard because she's like
hard.
She calls it nap time because she I don't know why she calls it nap time, which kind of works because you are just taking an extended nap. But she calls it nap time. She's like, always says to me, Mom, it's not nap time yet. The sun's still awake.
Yeah, right.
Yes, it is. But you need to go to bed.
Listen, Augie, let's give you a little worldly advice here. For when you listen to this when you're 16. Between 8 and 3, if we're working, we're tired too.
Yes.
And we will go to sleep when the sun is up. We'll do it.
Yeah.
You want me to crawl under a desk?
7? Sure.
I'll do it.
Yeah.
I'll do anything to get a nap.
Yep. Naps are great.
Naps are great.
You're going to miss those when they're gone.
Mm-hmm. But we're not going to nap today.
Not napping today.
Not during this podcast.
No.
Oh my gosh.
In fact.
This guy, he tried to think he wasn't going to get on our podcast.
Mm-hmm.
And nope. No escaping us.
No.
Not happening.
No, I think he secretly wanted to escape us, but it's kind of hard to escape us.
Yes.
Anybody at Centris is free game. So, all
Warning
right.
to everybody.
All right, listeners, you're not going to want to nap during this one. You're going to want to put on your detective hat because we're diving into a topic that can feel a little mysterious.
Ooh.
Credit. Today's podcast is going to take us back to the show Mythbusters.
Yes.
So get ready to separate fact from fiction as we tackle your most burning questions and help you master the power of your credit score. Joining us today is our favorite Mythbuster. Don't tell the other AVPs. And our very own credit guru. He's actually been in the financial industry for 39 years.
I know. I cannot believe that.
I can't believe that either. Like, he doesn't look a day over 25.
Right.
Which 25 of those years, he was with Centris.
I know. Isn't that amazing?
That's so
I
amazing.
love it.
I know that like just happened in, I want to say June. So he's freshly 25.
Yeah.
Chantel.
Yes. Liz.
Myth or fact? Ooh, this guest actually has his Bachelor of Science degree in agribusiness.
Oh, goodness. I'm going to go with fact.
You are correct.
Yes. Yes.
So he's like us, not mapping. Not mapping.
Oh, no.
But now he is.
But now he is. He's a huge mather.
He's a
now.
huge mather. He actually oversees our Grand Island and North Platte branches. Shout out to those branches.
Mhm.
He's the Assistant Vice President of Retail Financial Services. Please welcome to the show the guy that's about to give us the real deal on all things credit, Ron VanSkiver.
Woohoo!
I wish I had like audio.
Hello.
Hello.
Studio live audience clapping.
He's joining us virtually, and I loved how you would say something funny, and then there's a small delay, and so I'm like, oh, he didn't laugh, and then he laughed. I'm like, okay, good. Okay, good. We got this. Oh, Ron, thanks for joining us.
Yeah, it's a pleasure. Thank you.
Yeah. So Ron's been on vacation, so he is just chill and
He's
ready to
relaxed.
roll, and he's going to ask or answer all these questions for us. Myth, fact, all the things about credit. I'm just trying to dive right in.
Yeah.
And maybe I could use my words appropriately today. They're all mixing up for some reason.
That's probably why they had two of us on the show. So if one host can't talk, the other one's kind
one of them starts short circuiting this one, then we just can play on, playa. All right. I don't know what's happening. It's so late in the day.
It is. It really is. This is probably one of our later podcast recordings.
Yeah. We can't find a good medium because sometimes in the morning we're like, oh, it's so tiring. And then
The afternoon
we're
goofy.
okay, here we go. Ron,
Ron,
buckle up.
You're getting the best of us
All right.
or the worst of us. I'm not sure which.
All right.
All right. Opening questions. Let's get this show kind of kicked off with some just overarching things. So what exactly is credit and why does it matter in today's financial world?
Well, I guess, I don't know, to me, the almost dictionary definition, right? Credit's the ability to borrow money under the agreement that you're going to repay the debt later, usually with monthly payments. And it really matters because people usually need to incur some debt to get ahead in life. I mean, what's the alternative, right? To save up all the money first? Well, that's pretty impractical when you're talking about the cost of a vehicle or a home, right?
Mhm.
So,
Right.
Yeah. We hear a lot about the credit score and, why that's so important. So kind of talk us through that and how does that impact our lives?
Yeah, okay. Well, a credit score is typically a 3-digit number, generally between 300 to 850, that measures your credit risk or the likelihood of repaying borrowed money over time. So credit scores can determine whether a borrower can obtain a loan and then what interest rate you're going to pay. The higher the score, the lower the risk and the lower the interest rate. So, this can have a really big impact on a person's life. It can determine whether one qualifies for a loan to buy a car, buy a house, or even whether you can borrow any money without collateral. And then it also determines how much you're going to pay in interest. So, those two things can have a very big impact on a person's or a family's financial well-being.
Absolutely. And I think that we, as we learn more about credit and all the things that we're doing on a daily basis, it is such a big piece of the puzzle, right? And how we can look at what we're going to be able to afford going forward. And we've talked a lot with our partners at Green Path about where your credit score is going and how that can impact things and how that can impact emotional drivers and things from that perspective. So I think today's the Mythbusters aspect of this podcast, something totally different than we've done before, but there are so many, I think, myths or maybe misconceptions about what you should be doing to increase that credit score that maybe we can get answered today. So are you ready to jump in with this?
We're ready.
Okay. All right. So let's start with the first one. Fact or myth, Ron? Checking your own credit score will lower it.
Well, that's a myth. Those are called soft pulls in the industry. And actually keeping track of one's credit score is a really smart thing to do, as it can help you catch and correct errors. Or it can even make you aware of a problem, maybe like a missed payment or an old account that still has a balance due. Just personal anecdote. Years ago, we had moved and had an old Sears credit card, right? And we were in the store, used the card, totally forgot about that our address was incorrect. So it went to the old address that we hadn't lived at for 5 years or better. Well, I ended up checking my credit, and lo and behold, here's this Sears debt for like $35 out there, so I took care of it. But had I not checked my credit, it would have sat there and I wouldn't have known about it.
Right.
So there's a lot of good ways to check up on your own credit. Credit bureaus offer ways to check your own score, like you can go to Experian.com. Myself, I have the Experian app and a membership, so I can keep tabs on mine. All kinds of other alternatives like Credit Karma and whatnot.
And there are 3 main credit bureaus, correct? And you can pull the credit score from any of those, and it's still, again, that soft pull, correct?
That's correct. So, for example, with my Experian account, I can compare my score from any of the 3 major bureaus, Experian, TransUnion. Gosh, my mind went blank. But anyway, from all 3 of them. So it's kind of cool because you can, and there'll always be some subtle differences, just depending on the reporting.
Right. Absolutely.
All right. Next one. Fact or myth? You should carry a balance on your credit card to build credit.
Well, using one's credit card is a great way to help build credit, but it's not necessary to carry a balance from month to month. You can borrow and pay off the card each month and still build credit just fine. So I'd say that's a myth.
Okay.
The main thing is proving to the credit card issuer that one can make timely payments, not get overextended. And that's just a good way to, over time, be able to expand one's credit limits, which is what really is going to help you improve your credit score. Because it is the second largest factor within a credit score is measuring your credit utilization ratio, or that's the percentage of the credit line being accessed. So generally, it's best to keep your monthly balances relatively low compared to your credit limits. Generally, a 30% utilization, for example, is a good target.
I know on some of our past episodes, we've talked about credit cards and how you and I both went to college, and they're like storming you. Hey, you can get free pizza if you open a credit card. And I just remember you can get into a lot of trouble real quick with that. But at the same time, Ron, it is good to start, get a credit card, right? And use it, but in a way that's you you know you can afford it, and kind of talk us through that just a little bit as we kind of talk through credit.
Yeah, the main thing is really showing that you can be a responsible adult, right? That you can not get carried away with with the amount that you carry on your cards. And then the big thing really, again, the biggest factor in a credit score is on-time payments.
Okay.
So it's being able to make those payments on time when they're due.
Right.
Responsible adult.
Get the free pizza.
As my kids would say, adulting.
Adulting.
It's
yes.
hard, Ron.
Yeah.
All of it is so hard.
Adulting is hard. Yes,
I mean, if they throw a free pizza,
I know.
I do remember that. And
Yes.
I remember so my dad was in the financial industry when I was in college, and I remember calling him up and asking him like, "Hey, Dad, I get a free pizza if I open this credit card. Is that okay?" And he's like, "No, no,
no, and no."
it's a hard pass.
Yeah, go get a frozen Totino's.
Yep. You have ramen, okay? Just put some water in there and throw it in your
Yes.
little microwave in your room. You'll be fine.
Exactly. Yes.
All right. Next one, fact or myth. Closing a credit card account actually hurts your score.
So interesting.
Well,
Good one.
that's a fact. In most cases, that's true. We just talked about credit utilization being a large factor in your score, right?
Mm-hmm.
So if you think about this, closing a card will actually reduce one's overall credit limits, which will result in a higher utilization ratio, right? So for example, if I have two credit cards, let's say each with $1,000 credit limit, and I owe $500 on one card and have a zero balance on the other. Well, right, you do the math, 500 divided by 2,000 is 25%. Now, if I close the card that has a zero balance, all of a sudden my credit utilization jumps to 50%, right?
Yep.
Just because I closed the card. I didn't change the amount of debt I had. I just closed the card. And so again, when that's the second largest factor of your credit score, that can have a big impact.
Yeah.
And the other factor involved is that the age of your trade lines can help your score. So in other words, the higher the age of your oldest trade line, the more it's going to help your score. So again, using myself as an example, my oldest trade line is from 1985. It was a credit card that my parents co-signed for me back when I took a trip to Mexico City as a kid over Christmas break, and I still have it today just for that reason.
Yeah.
So
Wow. That's great. All right. Yeah. That was a good one.
That was a really good one. Because, you always think I paid that card off. I'm just going to get rid of it. I don't need it. When in fact, you should just leave it open because it's actually helping you.
Yep.
Right.
Very interesting. All right.
So just carry the cards. Just
just all the cards. Right. Rubber band.
Gosh.
All right. Fact or myth. How much money? No. How much? What is wrong?
I don't know. Is she plugged in?
Hold on. Let me.
Rico, is she plugged in correctly? Or did you plug her into the short?
Yeah, I'm getting zapped like a dog collar today. Okay. Fact or myth. How much money you make affects your score?
Well, that's a myth because your income isn't reported to the credit bureaus.
Right.
So one's income is not a factor within the scoring models used.
All right.
In fact, over the years, I've seen people with very high incomes who had terrible credit scores. And conversely, I've seen people with low incomes have really good credit scores. So it's really more about how you manage your credit. That's what's much more important. Now, obviously, the higher income you have, the easier it should be to make one's payments on time. Mm-hmm. But then people sometimes with higher incomes also tend to spend more, and people do tend to live up to their means. And then sometimes some people live beyond their means.
Right.
So again, in short, it's more about how you manage your money, not how much you make.
Oh, that's great.
That's really good.
Yeah.
I mean, if you think about it, somebody could be making 6 digits and have terrible credit.
Right. Yeah.
Hmm.
The more you know.
The more. Yes. All I saw now was that star with the rainbow from the 80s.
I know.
Do you remember that?
Yes.
Yep. Yep. All right. Fact or myth? You can fix a bad credit score overnight.
Just like that.
Just like that. Magic wand.
If only it worked that way.
Right.
Yeah, that's really a big myth when it comes to improving a low credit score. It's much easier and quicker to do damage to one score than it is to fix bad credit. It can normally take considerable time to repair a credit score. So unfortunately, it's like a lot of other things in life, right? There's no quick fix. However, depending on the situation, there are steps that one can take that can produce relatively quick results to help improve a score. And this is where speaking to an experienced lender can really help, because an experienced lender can look at your credit report and make recommendations. So as an example, sometimes just restructuring debt can make a big difference. I talked about credit utilization, or the percentage of one's loan balances compared to one's credit limits, being the second largest factor in the credit score. Well, if someone's borrowed up to their credit cards, but let's say has equity in their home, well, just moving that debt over to a home equity loan or a HELOC loan could provide relatively quick score improvement, because it can quickly improve the credit utilization on the credit cards. And then with that, the borrower likely would get we'll get a lower interest rate. So it's a win-win. But, whatever the situation, the quicker one can address the adverse factors that's impacting your score, the quicker the score can begin to recover. But generally, that's going to take time and some positive history to counterbalance whatever is adversely impacting it.
And like we have said so many times on this podcast, asking for help.
Yep.
If you get into a situation where you need to look at all the things and figure out how to get it paid off, ask for help, because it only can get worse if you're not reaching out, right? Right.
Right.
You want me to do the next one? Okay. Yep.
Probably.
Yep.
Did I do the last one?
No, I did the overnight.
You
But
did?
That's okay.
Oh my
It's okay.
What is happening?
It's just a short commercial break for our guests. All right, here we go. Fact or myth? If someone pays off a loan, it will disappear from their credit report right away.
Well, that's a myth, because those loans stay out there. That's part of your credit history. So what's interesting is the problem loan with missed payments will generally stay on your credit report for 7 years. While a loan, let's say with on-time payment history, can stay on your credit report for 10 years. So in that case, the positive stuff is staying out there longer. But either way, it's going to stay there at least 7 years.
All right.
Interesting. I didn't know that.
You're in it for the long haul.
Yeah. Like I'm literally getting ready to pay off my car in September. Woohoo!
Yes. You're going to see it for another 7.
Right. I'm going to just see it sitting there.
Okay, I will really ask this question this time. Okay? All right, and I will do it right. Fact or myth? There is only one true credit score.
Well, there does tend to be a lot of commonality within credit scores, because usually they're built on similar models and systems. But this is a myth, because there are differences within credit scores. There's different models out there that can be used. And so, there's not one true credit score. There's a number of them out there, but generally the principles involved are the same, and the models are very similar.
Okay, perfect.
So then if this is more just like a question, just general question made for me. If there's so many different scores out there, which one as a lender do you look at? Do you look at all of them and then just kind of compare?
That depends on the lender. Every financial institution sets their own rules on what they're going to use for guidelines to determine where to extend credit and how much interest to charge and all that good stuff. So typically, typically a lender is gonna settle on one bureau to use.
Okay.
And pull that one credit score and use that. And then within that one bureau, again, there's different models that you could choose from depending on what you want to do. But again, the basic underwriting principles that you tend to talk about in lending, they all apply no matter what model you're using.
Okay.
Right. Make your payments on time. Don't get overextended. Have a good history out there for them to look at.
All right.
That makes sense.
Yep.
It's my turn, right? Yep. Fact or myth? Debit cards help build your credit.
No, that's a myth. Because when you use a debit card, you're using your own money. Okay. If you're an accountant, that's the difference between the terms debit, which rather than credit. So credit, you're using borrowed funds. Debit, you're using your own funds, and so you're not really showing that you can borrow money and pay it back on time. Right? You might maybe with your own financial institution. Right. If you're not using a debit card properly, you might actually be incurring a lot of overdraft fees and such. But it's not gonna show up on a credit report.
Okay. Good to know. A single late payment can hurt your credit score. Is that a fact or myth?
Well, that is a fact, and now depends on your definition of hurt, right? But the less positive counterbalancing history one has, the greater the impact it will be. So, for example, if you're a young person, let's say in your 20s, and you only have one or two credit cards, maybe a car loan, well, you could see your score fall considerably, with just a single late payment. And in fact, depending on just how many trade lines you had out there, how long you had been borrowing money, the impact could lead to a higher interest rate in your next loan, because it could lower your score from, let's say, maybe A paper to B or C paper. But then even somebody with really good credit can be impacted by one or two late payments. I know an example of a credit card that was used for a single subscription, and it was being paid by automatic payments. And this was a person with 30 plus years of credit history, no late payments. The subscription amount that they were charging on the card increased a little bit, and it turned out that the automatic payment wasn't sufficient any longer to cover the minimum payment that was required on the card. And since the amount being paid wasn't enough for the minimum payment, the payments were considered late.
Oh my God.
So hence 2 or 3 missed payments of less than $25 in this case resulted from the score falling from the mid 800s to the mid 700s. I mean, it was a good 100-point fall. Now, mid 700, that's still a great credit score, right?
Right.
This person wasn't adversely impacted, but I use it as an illustration of just how much, a couple 3 missed payments, even $25 can have on a really good credit score.
Oh,
so those payments are important.
I didn't even think about that with the
and those subscriptions could really get you in trouble, because you think about how many you sign up for and then kind of maybe forget once in a while.
Right.
Oh, dang. Everybody, look at your subscriptions this evening.
Yep. Make a list.
Make a list.
Make sure you know where they're going.
Yes.
All right. All debt is bad for your credit score. Myth or fact?
Well, that's a myth. Because, think about this. People who don't borrow don't have credit scores, right? You have to have some debt in order to build a credit score. So it can't all be bad.
Yeah.
Right. It can't all be bad.
How do I tell that to my 22-year-old who we've signed for his credit card, to help, right, to get started? And He just uses it like it's free money. And so then I'm like, okay, well, I'll help you pay this, but you're paying it with all of your money. Well, I don't have that money, but I'm building credit. What? No, wait, what? Like, that's not how any of this works.
Right.
He might be, but I'm the one that's getting totally screwed in this deal. Oh, credit cards and children.
Well, that's where they have to have skin in the game, right?
Right.
Yep.
Get a job, man. I hope you heard that, Ty.
Yeah.
This podcast is all about throwing our children
under the bus.
and husbands sometimes under the bus.
So good. Okay.
All right.
There is a credit blacklist where people get banned from borrowing. I don't know. Myth or fact?
Well, that's a myth. I mean, financial institutions, as we said, make their own independent decisions on guidelines for extending credit, right? So there's no like master blacklist out there or master naughty list that you can get on that, just automatically cuts you off. So
It's not like a Santa thing.
I was just going to say that the master.
Yeah, it's not like a Santa thing. Yeah.
You have been on that
For a long time.
master Santa naughty list.
Yeah, Master Santa naughty list. Yep. I've been etched in. Laser.
Yeah.
Yeah. That's just there.
Our producer, Rico, I feel like, we're just knowing each other, but I feel like you might be on the naughty list. Yep, he's shaking his head, folks.
Shaking his head. Yep.
This is why we're going to be just great partners here.
Yeah. Yep. We're going to be real good friends. Oh, yeah. There we go.
All right. No credit blacklist.
Nope. Not today.
All right.
Okay. All right, Ron. Anyone can control their credit score. Myth or fact?
Well, the word here that really trips me up is the word control, because I hesitate to use the word control because to me that implies that one can move one's credit score at will, and the formulas that are used to calculate credit scores are long, complicated logarithms with multiple factors. So control is too strong a word that implies command to me. So I would say that that's a myth. Now, having said that, one can, as we've talked about, one can certainly influence and set the direction of one's credit score with proper money management. But, it's not like you can say, oh, I'm going to make my score be 700 tomorrow instead of 650, right?
Right.
There's really no way to do that.
Right.
Did you black out at any point when he said algorithms and formula, like a really long formula?
Yes.
I was like, oh no, we're going to go into the math. Uh-oh.
He's going to go. Here he goes.
Here he goes. We're going to
away, everyone.
You're going to lose your hosts. You're going to lose them. You're going to lose them. There's math.
Oh, yeah. All right.
Okay.
Let's see. Math.
She almost said math. Myth.
Fact or myth? Your credit score will drop when you pay something off.
Well, that's a myth, and I mean, again, credit score is looking for on-time payments.
Mm-hmm.
So, right, if you're paying something off on time and you've made all those prior payments on time, that's actually a good thing, right? That's going to make your credit score go up, not down. And then just the fact that it's now in zero balance. Yeah, your car, there you go. That's celebration time, right?
Right.
Yeah.
In more ways than one. More ways than one.
That's right.
All right. Last one. If I'm applying for a loan and the lender checks my credit score will drop. Is that a fact or a myth?
Well, that's a fact with a proviso here. So yes, a single inquiry, which is known as a hard pull, if your financial institution is pulling it to check credit, for a loan application, can have a minimal impact, usually 5 points or less on one's credit score. So, will your credit score drop? Yeah, technically by 5 points. But that's 5 points is really minimal when you're talking about an 850 scale, right?
Right.
So technically a fact, but not enough of an impact that it should dissuade anyone from applying for the credit that you need.
Is there a time you should, wait for them to pull that? I know we've talked to our mortgage specialist a little bit. Like if you're buying a house, is there a time you should, say, okay, let's do a soft pull for now and then do that hard pull?
Well, it can depend. Again, it can depend on the situation, right? So if you've recently taken on some other loans and now you're getting ready to buy a house,
mm-hmm.
Okay, yeah, maybe you want to wait a month or so and give that some time.
Gotcha.
But again, it can really depend on the personal situation, right? If you're somebody and your credit score is in the high 700s, 800s, and that's probably not going to have much of an impact that's going to matter at all.
Okay.
If you're somebody with marginal credit, okay, well maybe you want to be a little more careful and give that loan a little bit of seasoning on your, some time to be on your credit report before you're turning around and taking on additional credit, because taking on, multiple inquiries done in a short period of time, or taking on, let's say substantial loans, that will have an initial adverse impact on your credit score.
Okay.
So
timing is everything.
Yep.
Just
don't get on that blacklist.
No, it doesn't exist, so it's okay.
Somebody has a blacklist.
Somebody has a blacklist.
It's not a financial institution. It's Santa. You just don't want to get on that.
Yeah,
one.
exactly.
All right, we've come to our known and loved part of the episode where it's a penny or two for your thoughts. What's one thing that you'd want to leave our listeners with? You can do myth or fact, whatever you want, as it relates to credit scores.
Well, I would, again, debt sometimes could be it is a 4-letter word, right? So, so sometimes people literally think just debt's terrible, right?
Mm-hmm.
But debt can be a good thing. Debt that's within your ability to demonstrate timely repayment, that's a good thing. That's going to improve your credit score. And remember, debt can allow you to do things that you otherwise couldn't do.
Right.
Own that car or own the house, etc. So in short, debt which helps one build a better life, hey, that's definitely good debt.
Balance, right?
Everything in moderation, right?
Right.
It's
There we go.
The thing of life. Everything in moderation.
That's right.
Awesome.
Oh, Ron, thank you so much for all of this information.
And for playing along in our little game.
Mythbuster extraordinaire.
Thank you for including me.
Of course.
Absolutely.
I greatly appreciate it.
Yeah.
We're gonna have to get him like a shirt.
Yeah. Mythbuster.
Mythbuster.
Yeah.
Yep.
I like it.
I do too. Centris Mythbuster. Coming soon to a company store near you.
Yes, absolutely.
Awesome, Ron. We always appreciate the opportunity to chat with you, even when it's not necessarily on a Zoom call like this, but even just in our meetings. We love chatting with you and catching up. And even when you're in the office, we love seeing your face. So
it's always a pleasure.
Thank you so much for joining us, taking time out of your busy schedule and providing our listeners insights on mastering their credit score and having a better understanding of what credit is and how it can actually help them. So for our listeners, we always thank you for listening. Sometimes can't believe that you're still doing it, but we do appreciate you.
Thank you.
Shout out to all our friends back at the office. They are some of our most loyal listeners. Sometimes they use some of the things against us. It's fine. It's fine. But if you like what you hear, be sure you rate, review, and subscribe so that others can find us, and give Centris a follow on all the socials. You heard me, socials. I'm just going to shore it up. Maybe you don't do it today because social media is a little crazy right now and you might not find us, but you can always search for Centris. We're there. It just might not be in the same feed as Travis Kelce and Taylor Swift.
As I'm looking at a video right now.
Oh, yep.
It's already been photoshopped with Jason Kelce in the middle of the engagement, which is fantastic.
From the footage of him jumping out of the window at the game.
Yes.
Yeah. All right. And if you want to consult with one of our experts like Ron for guidance on your finances, give us a call at 402-334-7000. And you can also visit our website and book an appointment just to meet up with them face to face. We really hope you enjoyed this episode and grabbed a few nuggets for your finances and credit. As always, thanks for listening.
Thanks, everyone.